VeChain just rolled out something wild. You can now earn Bitcoin, Ethereum, and USDT with over 20% APR on their network, and they're literally paying you to bridge your assets over. No service fees in October, zero lockups, dual rewards. And analysts are calling for a VET breakout as the tokenomics shift toward deflation. This isn't your typical DeFi hype cycle. This is structural. This is strategic. And if you're sleeping on VeChain right now, you might wake up wishing you paid attention. Let's break down what's happening, why it matters, and whether VET is finally ready to make its move. What's up, everyone? Welcome back to the channel. If you're new here, I break down crypto projects, market moves, and DeFi opportunities without the fluff. Just straight analysis, real data, and actionable insights. If that sounds good, smash that like button and subscribe so you don't miss the next one. Alright, let's get into it. VeChain's DeFi ecosystem just expanded in a massive way through integration with Wanchain. According to the official announcement from VeChain, assets from 47 different blockchains, including Bitcoin, Ethereum, and Solana, can now be bridged directly onto VeChain's network. That's a big deal, because it opens the door for cross-chain liquidity without forcing users into expensive or risky wrapping protocols. But here's where it gets interesting. Throughout October, VeChain is waiving all service fees for bridge transactions. You only pay gas fees on the origin chain. That means moving your BTC or ETH onto VeChain costs significantly less than usual, and you're immediately positioned to capture yield opportunities once your assets land. Now, VeChain isn't just asking you to bridge for fun, they're running a bridge-to-earn campaign that rewards participants with payouts in Bitcoin, Ethereum, Tether, or B3TR. That's right, you get paid just for moving your assets over. Even before you deploy into any liquidity pool or lending protocol, you're already earning. That's a dual reward model that flips the traditional DeFi script. So why is VeChain doing this? And more importantly, what's the risk? Let's think about this strategically. VeChain has historically been an enterprise-focused blockchain. Supply chain tracking, sustainability initiatives, real-world adoption. But DeFi liquidity has been thin. They need more capital flowing through the network to support decentralized finance applications at scale. By incentivizing users to bridge assets with immediate rewards and high APR pools, VeChain is essentially bootstrapping liquidity without resorting to inflationary token emissions. They're using campaign rewards to attract capital, then retaining that capital through competitive yield opportunities. It's smart. But it also means early participants get the best deal. Once the campaign ends and service fees return, the cost-benefit ratio shifts. Another question, can these APRs sustain? We've all seen DeFi projects launch with eye-popping yields, only to watch them collapse as the Tokenomics unravel. So let's dig into where these returns are actually coming from. Right now, two protocols are live on VeChain offering real yield opportunities. Let's start with BetterSwap. Their B3TR-USDT liquidity pool is currently offering over 20% APR. Now, B3TR is VeChain's sustainability token, already distributed to 1.7 million users through the VBetter ecosystem. That's a massive existing user base feeding organic activity into this pool. You're pairing B3TR with USDT, one of the most liquid stablecoins in crypto, which reduces volatility risk compared to typical volatile pairs. BetterSwap operates as a decentralized exchange aggregator, connecting VeSwap, VExchange, and VRocket. This means when you provide liquidity, your capital isn't stuck on one exchange. It's working across multiple trading routes, capturing fees from all activity within the VeChain ecosystem. That's why the APR can sustain at over 20%. It's not just farming rewards, it's real trading fees generated by actual volume. Now, if you're more conservative and high APRs make you nervous, Juicy Finance is offering over 10% APR on USDT lending. This is a lending protocol, not a liquidity pool. The returns come from borrowing demand within VeChain's growing DeFi ecosystem. Borrowers are over-collateralized, and Juicy Finance implements institutional-grade risk controls. Your principal stays protected while generating passive income. It's not as flashy as 20%, but it's stable, predictable, and lower risk. Here's my take. The 20% APR on BetterSwap is attractive if you're comfortable with impermanent loss risk and believe in VeChain's long-term ecosystem growth. The 10% on Juicy Finance is better for capital preservation with steady yield. Both are legitimate opportunities, not vaporware promises. Let's talk about how this bridge-to-earn program actually works. You bridge your assets onto VeChain during October. You immediately earn rewards in BTC, ETH, USDT, or B3TR. No lockups. No staking requirements. After that, you can choose to deploy those assets into BetterSwap's liquidity pool or Juicy Finance's lending protocol. Or you can just hold the rewards and bridge back out. The capital stays in your control. This is a huge departure from traditional DeFi incentive structures, where you're locked into staking periods or forced to hold governance tokens with unclear exit liquidity. VeChain is building long-term liquidity by making participation frictionless. And because the rewards are distributed in assets like BTC and ETH, not just their native token, they're avoiding the inflationary death spiral that kills most yield farms. Now, VeChain isn't stopping here. According to their roadmap, they're finalizing a VET USDT pool. This is massive for VET holders because it gives them a direct way to earn yield on their native token holdings without leaving the ecosystem. More stablecoin pools are also in development, which signals VeChain is serious about building diversified DeFi infrastructure. The broader strategy ties DeFi activities directly into VeChain's sustainability initiatives through VBetter. That 1.7 million user base isn't just holding tokens, they're participating in real-world impact programs. That feeds organic activity into trading volumes, which supports long-term yield sustainability. This isn't mercenary capital chasing the next farm and dump. This is ecosystem-aligned liquidity. Now let's zoom out and talk about VET price action. Over the past 24 hours, VET is up 2.65%, trading at 2.4 cents. Over the past week, it's up 9%. That's not explosive, but it's steady accumulation. According to data from CoinGlass, open interest in VET derivatives rose 5.21% to $111.45 million. That tells us traders are opening new positions, expecting volatility and potential upside. Technically, VET's 7-day RSI sits at 60.59. Anything above 60 signals bullish momentum building. The MACD histogram shows a positive shift at plus 0.00000886, meaning bearish pressure is weakening. VET is also trading above key moving averages, the 7-day SMA at 0.0224 and the 30-day EMA at 0.0235. These are classic confirmation signals for a near-term uptrend. Analysts are watching the 0.0251 level closely. That's the 23.6% Fibonacci retracement, and a sustained break above it could trigger accelerated buying. The next major resistance zone sits between 0.028 and 0.033. If VET breaks through that range, we could see a move towards 0.050. On the downside, strong accumulation continues around 0.022, which many traders view as a stable support base. Crypto analyst Michael van de Poppe recently shared his perspective on VeChain's evolving tokenomics. According to van de Poppe, the adjustments underway are designed to make the system more balanced and potentially deflationary over time. This centers around VTHO, VeChain's gas token. Instead of being generated automatically, VTHO will now primarily be earned through staking and active network participation. Van de Poppe explains in that way the community should continue to grow as there is lower inflation within the ecosystem. I think that this is still one to break out of the trend and have a positive return. So, what's the verdict? VeChain is making a serious play to establish itself as a legitimate DeFi ecosystem. The Bridge to Earn campaign lowers barriers to entry. The 20% plus APR pools offer competitive yields backed by real activity. The tokenomics shift toward deflation creates long-term value capture. And VET's technical setup suggests accumulation is happening quietly beneath the surface. Is this a guaranteed moonshot? No. Nothing in crypto is. But VeChain is building infrastructure, not hype. They're aligning incentives, attracting cross-chain liquidity, and rewarding participation without inflationary gimmicks. If you've been waiting for a clear entry signal, this campaign might be it. If you found this breakdown valuable, hit that like button and drop a comment letting me know what you think. Are you bridging assets to VeChain? Are you bullish on VET? I read every comment. And if you want more deep dives like this, subscribe and turn on notifications. This video is for informational and educational purposes only. It is not financial advice. Cryptocurrency investments carry significant risk, including the potential loss of your entire capital. Always do your own research and consult with a licensed financial advisor before making any investment decisions. I am not responsible for any financial losses you may incur.